Hi there, everyone. Welcome, and thank you to our attendees and our panelists for joining us for today's event. My name is Erica Hanachek. I'm the Government Affairs Director at the Financial Accountability and Corporate Transparency, or FACT Coalition, and one of the three authors of today's report, Private Investments, Public Harm. The FACT Coalition is a nonpartisan alliance of more than 100 state, national, and international organizations committed to combating the harmful impacts of corrupt financial practices. We are proud to co-host today's event with two of our members, Global Financial Integrity and Transparency International's U.S. office, who are also co-authors of this report. We're excited to dive into today's event to discuss an $11 trillion question. How can the U.S. mitigate money laundering risks through its private investment industry? An industry which, if it were its own economy, would constitute the third largest economy in the world. An FBI memo leaked last year revealed the growing interest in U.S. private markets as a destination for illicit finance, drawing in criminals, kleptocrats, and sanctions evaders alike to invest their illicit proceeds in U.S. private equity, hedge funds, and other private investment funds. While these illicit actors are attracted to U.S. markets for many of the same reasons as legitimate investors are, for the promise of long-term growth on their funds, they are likewise attracted by three major factors that make the U.S. private investment market prime for putting away the proceeds of crime and corruption. The U.S. private investment market is large, it is complex, and it is opaque. Despite three attempts by Treasury's Financial Crimes Enforcement Network to bring this sector under anti-money laundering regulations, the private investment sector is completely absent of the safeguard required for other financial actors such as banks, but also other actors in the investment space, including broker-dealers and registered investment companies. As a rulemaking on another key U.S. transparency measure, the Corporate Transparency Act, which effectively bans the use of anonymous U.S. shell companies, is expected in the coming days, doors for illicit financial flows in the U.S. are closing, only increasing the risk that illicit actors will turn to U.S. private investment as a destination for their ill-gotten gains. On the eve of the Summit for Democracy, the United States has a mandate to mitigate its role in fueling international corruption. Transparency in the private investment sector is key and also will yield tangible benefits for the average American. It's with that we'll turn to today's discussion. Now, due to Senate business, unfortunately, Senator Whitehouse was unable to join us today for the keynote, but he has pre-recorded a message on the occasion of the report launch. We'll play that message for you now.
Hi, this is Senator Sheldon Whitehouse. First, let me thank the FACT Coalition, Transparency International, and Global Financial Integrity for the release of this important report, Private Investments, Public Harm. As you know, I believe very strongly that we are in a clash of civilizations between rule of law civilizations and countries that are governed by autocrats, by kleptocrats, or infiltrated by criminal groups. And one of the things that we need to do in this clash of civilizations is to try to make sure that the ill-gotten gains stolen by the kleptocrats, the autocrats, and the criminals do not find shelter in our rule of law institutions. Without strong anti-money laundering protections, private equity and hedge funds help kleptocrats and criminals stash their ill-gotten gains. In June, President Biden issued his first national security study memorandum, establishing the fight against corruption as a core national security interest, and noting the need to combat illicit finance in all forms. Anti-money laundering rules apply to much of the financial system, but the recent Pandora Papers show we need to up our game. Private investment funds, including private equity, venture capital, and hedge funds, manage over $10 trillion, yet have no anti-money laundering requirements. This could be the largest hole in our anti-money laundering framework. The Obama administration proposed a rule back in 2015 to address the problem by extending anti-money laundering safeguards to registered investment advisors. But that rule is still not finalized. It's time for the Treasury Department to address the national security risks posed by our private markets and finalize the Obama rule. We also need to take a closer look at other professions, other enablers of money laundering, like lawyers, accountants, and company formation agents that also escape anti-money laundering safeguards. This is an area where I'm working on further legislative solutions. This new report shines light on a big problem, The United States can't address corruption without tackling money laundering in all its forms, and that includes private equity. Thanks for the great work you have done. I'm glad to have this chance to be with you.
Thanks very much. And we're very grateful to Senator Whitehouse for his continued commitment and work to introduce greater transparency into U.S. financial markets. Now with that, I'll turn over to our panel. Let me introduce Lakshmi Kumar, Policy Director at Global Financial Integrity and a co-author of this report. Thank you.
Thank you, Erica. And it's a pleasure to be here, not just with, all of us that wrote this, but, the tremendous support that we got from John and David and others that have continued to work in this space. But Erica set the topic up beautifully. And I think there's often no better way to illustrate the complexity of this issue through, the tool of storytelling. And I think that's what our report tries to do. We have collected a whole plethora of case studies to really show that this is not a theoretical problem. The problem is very much grounded in fact, and there are numerous examples that are of vital concern to U.S. national security, U.S. economic security, but also significantly pose a corruption, terrorist risk, and a organized crime risk to the U.S. economy. And drawing through these multiple case studies, we hope to make the argument and very conclusively show that the private equity and the use of these complex vehicles is not the purview of just the legitimate investor. It is very much the purview of sophisticated criminals who think long-term horizons and who have the know-how and knowledge to exploit these complex vehicles. Now, we have about 11 cases in our report. In the interest of time, I'm going to sort of quickly run through about 3. And I will say that our report really clubs these examples into 3 distinct categories. And they are illustrative of why the rule is so important. One, the first category is of cases where we really found situations where the investment advisor in question just simply follow what were obvious red flags. And in many cases, because there is no requirement to do so, it's easy to make the answer that there is no need to follow these obvious red flags. In a second case, the fact that there is no requirement allows these structures to operate with increased opacity, which means getting to those answers you need to conduct due diligence becomes that more challenging. And perhaps most concerning, we also have examples that are in this report, which really show the complicit behavior of sometimes actors, where they're aware of this rather critical gap in the way that the regulations operates around this sector and have exploited that to willfully participate in a criminal act. Now, the first example, which I think will be of interest because this is something that we have seen crop up a lot, and it was the subject of a 2018 Department of Defense report, which really found that the Chinese venture capital investments were giving the Chinese government access to essentially the crown jewels of US innovation. Investments were occurring in vital US sectors, including in data management, security, artificial intelligence, drone technology, all of which were important to the US. And one such example, which we illustrate here, is that of Dunhua Capital, which is a venture capital fund based out in California near Stanford that made significant investments in Cohesity, which is a data management and security company, which had contracts with both the Department of Energy and the US Air Force. Now, unknown to the US government was that Dunhua Capital was essentially both established and provided financial assistance through the Zhongguancun Development Group, which was essentially a state-owned enterprise funded by the municipal government of Beijing. And this is not a standalone example. What we were able to tell from both reports with the Department of Defense, but as well as other reports, really shows that more than 20 venture capital funds in Silicon Valley all have close ties to the Chinese government and are backed by either Chinese government state-owned enterprises, whether it's in Huangzhou or other places, all of whom are usually based out of California. And it is not just Chinese government involvement that we have seen in sensitive US technology sectors through these investment vehicles. We've also seen the same, as our report details, with Russian investment in these sectors as well. And therefore, it really shows that these vehicles provide the perfect foil through which to provide enough layers through which you can separate the identity of the investor from the actual investor, which in this case, it is the Chinese government. Now, I think the next case, which is, I think this is a great way to illustrate how important tackling these vehicles and putting the role into place is important from a national security perspective. But when we talk about sort of drug trafficking and organized crime, it is important to know that a lot of these vehicles, they're not just a way to sort of invest money, but they're also a way to invest money in assets like real estate. Now, Sephira Capital is a boutique real estate investment firm based out of Florida. And they've invested over $100 million in commercial and residential properties all across the US. Now, what investigations with the DEA established is that Sephira was receiving hundreds of millions of dollars that they were investing, but they were receiving millions of dollars from essentially drug trafficking organizations that were laundering money through a trade-based money laundering mechanism called the black market peso exchange. And what the DEA did is they gave proceeds from the sales of narcotics to Sephira Capital. Sephira Capital accepted this money, no questions asked. And in some case, the DEA would say, this is the investor giving you the money, but the entity that actually gave the money to Sephira was completely different, no questions asked. In some cases, the DEA, as part of its investigation, would say, hey, this is the money we're offering, this is the money we promise you, but this is, they would receive a completely different sum. And again, no questions asked. And this just goes to show you how easy it becomes for drug trafficking organizations and how sophisticated they are to exploit these vehicles. And finally, the last example, which is one of tax evasion, where US citizens were able to use Finacor, which was a Swiss-based cross-border asset management company, to essentially open up undeclared accounts in Switzerland and conceal income from the IRS. The way they did it was rather simply is that once they would initially Finacor would hold US citizen accounts in what was called asset management accounts, which means each client has an individual account with a financial institution. Once they realized they were supposed to declare some of this information to the IRS, what Finacor did was they clubbed these accounts into fiduciary accounts, which essentially meant that Finacor would be responsible. Finacor clubbed all these accounts for all these US investors under one account. So the bank would only conduct due diligence on Finacor, but the bank would never be able to know the identities of all the individual account holders, which meant that Finacor was responsible for doing the due diligence, which, of course, because they were complicit actors in trying to assist US citizens from declaring income to the IRS, had no interest in doing. Subsequently, through an investigation, they did agree to a non-prosecution agreement and turned over all these finances. But it is yet another example which showcases that these vehicles continue to provide essentially a variety of risk: national security, organized crime, corruption, and tax evasion. But with that, I will stop and happy to answer any questions, but I will hand it over to the rest of our esteemed panel.
Great, thanks so much for those examples, Lakshmi, really, really informative. Next, let me turn it over to Gary Common, the Director of the U.S. Office of Transparency International, and the third and final co-author of this report. Thanks.
Thanks, Erica, and thanks all for joining. Glad to be on this panel with some terrific colleagues that have been doing a lot of work in this space over many years, and so thank you for your work as well. I want to highlight two aspects of the report, building on what Lakshmi just laid out in the examples, and I encourage everybody to read through the rest of the examples. They're all extremely informative on how the system gets manipulated. So the first thing, though, that the report makes clear in two ways, one through the studies, but also through some of the other narratives, some of which were mentioned by Erica and Senator Whitehouse, is what we're proposing as solutions, what we're asking for, is not new. It's not radical and it's not unusual. Just to sort of run through, back in 2001, when the BSA, the Bank Secrecy Act, was expanded, it said financial institutions need to have anti-money laundering responsibilities. The private investment, well, the investment sector got a temporary exemption. That was narrowed later in the year, in 2002. But by September of that year, there was a draft rule. It was never finalized, and by 2008, it was withdrawn. In 2015, as you heard, under the Obama administration, a new rule was drafted. The point of all this is that people have long recognized that this is a vulnerability and a threat. Others in the industry have these requirements, and it's time that we finally get it done. Also, the urgency, I think, is stepped up for two reasons. We're seeing a lot of money, generally, both clean and dirty money, going into the private investment industry. The sector has grown enormously, as we point out in the report, and with other avenues for laundering dirty money closing, that is, additional rules on banks. They're now collecting beneficial ownership information, so the true owners of who's opening accounts. There's movement in the real estate sector. And so we would expect that the money is going to flow where it can be hidden and where it can be effectively laundered. That's the private investment sector is going to be increasingly attractive, and we expect that will grow. Given the fact that broker dealers and others in the industry have these rules, I would also argue that it's fairly arbitrary that we don't include the investment advisors. Imagine if we passed a law saying that green cars have to stop at stoplights, the yellow cars don't. People would say that's crazy, and yellow cars are creating a hazard. And so if in fact we believe that due diligence rules are important for broker dealers in the mutual fund and other investment vehicles, it makes absolutely no sense not to assume that an $11 trillion private investment market or alternative investment market is not creating threats. So with that, let me focus a little bit on what are we specifically asking FinCEN to do. And so what we're asking them to do is to draft, propose, and finalize a rule that revokes the temporary exemption and provides anti-money laundering responsibilities to investment advisors and unregistered investment companies. They should have the same investment anti-money laundering responsibilities that banks have and other actors in the investment sector. The rule needs to cover all actors, and we think the 2015 rule is a good start, but developments have shown that the investment industry has contorted itself in new and different ways that were not necessarily contemplated or fully understood in 2015 or in earlier versions of the rule. So for example, there's been a lot more attention and focus on family offices, which have grown tremendously in the last 10 or 15 years. And so that now becomes a concern, whereas years ago, I'm not sure we fully appreciated or understood. So we want registered investment advisors covered. We want to make sure that advisors working solely with private equity, hedge funds, venture capitalists, and all the alternative investment vehicles are covered. Investment advisors that are working with rural business investment companies and advisors working with foreign private investment funds. The reason we point these out in particular is because they have had exemptions specifically in previous rules and in previous iterations, and so we want to make sure that those are covered. And what is it that we're actually asking the rule to do? It's to do basically three things. We want to make sure that they collect beneficial ownership information. We want to make sure that there's ongoing monitoring of accounts. So it's not just a one-time thing, but they're monitoring money flowing in and making sure that there's not clean money coming in the beginning, but then it switches over to dirty money later on, and that they are engaged in filing suspicious activity reports with Treasury's Financial Crimes Enforcement Network, making sure that they're pointing out where they see potential risks. So the 2015 rule, as we said, is a good start, but we think it needs to be updated to meet these new developments, to truly protect the financial system and make sure that there's not opportunities and loopholes for exploitation. And with that, I'll turn it back over to Erica. Thanks.
Great. Thanks so much, Gary. Then let me invite David Zacconi, who's the co-founder of the Anti-Corruption Data Collective and also an author of an earlier report on money laundering and private equity titled In the Dark. David?
Hi, everyone. Thanks so much for having me over here. I want to commend the authors of this report. It really is a fantastic exposition of a really pressing issue that not enough people have been paying attention to, I think, over the last 5 or 10 years, at least in broad strokes, to bring together just the variety and also the quantity of cases where malevolent actors have abused the system, where regulators have simply kind of looked the other way and not refined the necessary rules to prevent this type of abuse. And I really think there's just real potential for further harm if we don't take more action now. And the proposals that are put forward in the report, and then Lakshmi and Gary both touched upon, are just spot on. And there's just real risks that the longer we kind of allow this loophole to remain open, the worse consequences we're going to face later. I want to talk a little bit about how, building on what Gary was saying, is that this isn't a new conversation. And just as this happened in the past in the United States, the EU, mainly through a couple of its member countries that have seen a lot of money come in through the private investment industry, such as the UK and Luxembourg, has had these debates before and has actually made more progress in the United States in terms of tackling many of the problems head on. I want to talk a little bit about the two sets of reforms that several EU countries are in the midst of implementing. Now, it's not completely successful and enforcement has been lagging, but in many respects, the rules are already in place to create a kind of a better future than even the countries were a couple of years ago. And they kind of tackle the two main issues that we're talking about. And first is that these investment advisors and the variety of actors are not performing adequate due diligence and anti-money laundering rules themselves. And one of the arguments you hear from the industry is that, well, most of the actors are already doing it in some respect, and they're reputable institutions. They have some things in place. We can trust that they're doing the right thing. Well, I think the EU didn't take these firms' word for it, and they required and have started to coordinate that there be more centralized and more coordinated and more verified AML procedures across the entire industry to kind of set out the best practices that everyone needs to follow. And one of those being, if dirty money comes across your radar, then you need to report it to some type of regulatory authority, and a suspicious activity reporter, it's equivalent. So just like Gary was saying, this requirement to allow FinCEN to enforce suspicious activity reporting from investment advisors is already in place in several EU countries and is starting to reap benefits, although, like I said, there are problems with enforcement. And the second is that a lot of times the dirty money comes in at various different stages. And what you see is a lot of passing the buck, in that investment advisors say, well, the money comes in through these custodian banks. And because banks are covered under AML rules, we can be confident by the time that it reaches us, it's already been validated. It's already been checked. Therefore, we're kind of antiquated. We don't have the same type of technological tools as the banks. We're just ill-equipped to look that deeply into the money coming in. Let's just trust that the banks that are on the front lines are doing their job. Well, unfortunately, many of those banks are located in places that are not covered by FATF rules, or they're not playing by those rules, and they just don't have the same type of procedures in place. So money can sneak in, and then the advisors are kind of not holding down their part of the bargain and allowing the money to enter the system. So I think the second big reform that many EU countries have done under the 5th and EU anti-money laundering directive is to install universal beneficial owner transparencies that cover private equity, that cover hedge funds, that cover this entire investment industry. And those two prongs, those two weapons, I think have a great potential, like I said, to prevent future harm in the EU, and there are real lessons to be learned in the United States. So more specifically, what does this mean for authorities? What does this mean for policymakers? Well, like Gary said, there needs to be a rule change where FinCEN is requiring investment advisors to submit suspicious activity reports, but also we need to fund FinCEN to actually be able to analyze these reports and monitor them so that it can take action when things are awry. And as investigative journalists have uncovered over the last year, that doesn't always happen. And we need to make sure that FinCEN has the budget and has the capacity that it sorely needs in order to monitor this stream of endless information. And the second one is that, this is probably a little beyond the scope of this conversation, which is more about rulemaking, but Congress needs to amend the CTA to ensure that private equity is not treated differently and has to reveal and report its beneficial owners, and not necessarily at the 25% threshold, which is under the CTA, but at a lower one, because these funds are diversified, they're pooled, they have many, many different types of investors. And what the EU experience has taught us, specifically in Luxembourg, is that a mild universal beneficial ownership or ultimate beneficial ownership requirement is not enough to tackle the opacity issues in this industry. And we need to lower it to something where we can cover many more of the different type of players that are investing their money. That unfortunately has to come through Congress, but it's almost ludicrous how private equity and a lot of these other actors have gotten a free pass from the strongest transparency legislation that we've had on the books in so long. And there's just not justification. I think this report makes a really clear case that there shouldn't be special treatment. There shouldn't be a yellow car lane, as Gary really kind of illustratively said, that allows them to kind of bypass some of the rules that we know to work and that we have experience from other countries to be working well. So thanks again, congratulations, and I encourage everybody to look at the report. It's a thrilling read, if not a bit depressing.
Great, thanks, David. Honored to have our work described as thrilling. Appreciate that. Then I really want to make sure we have a chance to talk about this, not only in the abstract. A lot of what we're talking about is in terms of broad strokes around bad actors, criminal proceedings, all that, but we want to be able to zoom down and reflect how transparency in the private investment sector matters to the average American. So with that, let me hand it over to John Keenan, Corporate Governance Analyst for the American Federation of State, County, and Municipal Employees.
Thanks for that, for being, this great report being out, and it's an honor to be here. John Keenan with AFSCME. I wanted to just kind of present some overall problems with private equity and the model from a labor perspective. And here I'm going to focus on two areas. One is direct harm to workers when private equity comes in and buys companies. I'll give a couple examples there. But then two, a big problem for investors, including workers' pension funds, is the lack of transparency that private equity provides and around fees and their holdings. And it's a huge black box for investors. And there's really some things that need to be done there. So what happens to workers? Really, the private equity model could be kind of considered the bust out model, where a group comes in, takes over a store, sells everything of value, and then when everything's gone, they walk away. What private equity does often is they do leveraged buyouts, where they load up a company with debt, and then they manage it, extract fees, everything goes well, the company gets returned to the public markets, everything goes bad. It's basically a heads I win, tails I win, tail for the private equity firm. They do well, but the companies close and workers lose their job. So a couple examples. One, Toys R Us. It was a profitable company in 2005, worth $7.5 billion. Private equity said, hey, let's come in and invest here. They did a leveraged buyout where they put $6 billion in debt and $1 billion in equity to buy the company, profitable company. And basically that resulted in $400 million a year in interest payments that the company had to pay now. Fast forward, company goes bankrupt, 900 stores close, 33,000 workers lose their jobs. Meanwhile, the private equity, Bain and KKR, walk away and made money, extracted $500 million in fees. Another quick example, Janesville, Wisconsin, a door factory, Huffcore, bought by OpenGate in 2017, been around 120 years. They said they weren't going to, the jobs would be there. 2021, they announced they're moving to Mexico. 166 workers, been in the community for years, out of a job. Finally, a recent example, Apollo and Warrior Met Coal. Warrior Met went into bankruptcy in 2016, Alabama Coal Company, metallurgical coal that's used for making steel. Basically, the workers came together, Apollo came in, bought the company, the workers said, hey, we want to save the company. They took pay cuts, 20% pay cuts, forced overtime, no holidays, company returns to profitability. Workers saved the company, 1.1 billion. Apollo pays out, the company now pays out $800 million in dividends, and Apollo sells out. These workers have been on strike for 10 months now. They're locked out. They haven't been, the company's profitable again, and they're not getting a deal. And, the company won't come to the table. Apollo walked away. Apollo invests billions on behalf of public pension funds. So that's some of the problems of what happens to workers. The other issue is as an investor. Public pension funds have over $700 billion invested in private equity. And yet there's huge problems. One, they're really expensive, cost 2% in management fees, and then private equity takes 20% above certain levels of profit. So they're getting a share, but they're not putting in any equity. So it's really hard to make good returns on those kinds of deals. Then funds don't even know what they're paying. There's a lack of transparency around the fees that they're paying. So the private equity firm is charging management fees, performance fees, portfolio fees. These are not always being reported to the pension funds that are invested as limited partners. The SEC looked at 150 funds in 2014 and found material violations on fees and expenses, meaning the limited partner was being ripped off 50% of the time. So that is indicative of a huge problem. So basically funds are getting ripped off, but nothing's being done. What can be done about this is that there needs to be greater transparency around what the fees are, whether they're side deals, and basically also Form PF, which is disclosure of the company's private equity's holdings, as well as their sources of credit. This is a huge area of oversight that is lacking. And within that, the SEC and Chair Gary Gensler has actually identified this. He gave a recent speech to the Institutional Limited Partners Association, saying that there needs to be disclosure of fees. Funds don't actually understand what the returns are because there aren't uniform measures there. There needs to be standards of care where the private equity managers can't contract to a lower standard of care with pension funds. Huge problem. Like, basically private equity says, hey, sign this contract to lower the standards that we're responsible to you for. And then also to the Form PF, but then disclose anytime there's compliance violations. If there are 50% of funds are getting ripped off, that means private equity, there's some problems. We'd like to see when that happens, and then also increased enforcement actions. What are the solutions? Hopefully the SEC says they're going to come out with a transparency review and new disclosures for private equity in the next year. So we're really excited about that. And then legislatively, there's also the Stop Wall Street Looting Act by Elizabeth Warren, which would set up protections for workers and companies taken over by private equity, as well as requiring these disclosures that I talked about. Thanks.
Great, thanks so much, John. And it's crucially important to know for workers to know who owns the company that they're working with and who's investing in. Even if it's not sort of public, that type of public information, it's still critically important to make sure it's not illicit finance that's flowing through. So I'm really grateful for your perspective and the work that you've been doing to increase some of this transparency in this sector. With that, we're going to turn to the Q&A. Thank you again to our panelists for their remarks. Let me encourage you to use the question and answer feature that's available as part of the webinar. And while you all prepare your questions, I'm going to tee us off with a few that I have of my colleagues just to get the conversation started. But I am curious to hear a little bit more from the panelists, on a question around the types of money, like the types of investments that are most at risk. And we usually think of private investment as a long-term investment. But I'm wondering if you can point to examples in which there are short-term applications that, again, money launderers, kleptocrats, criminals might use to exploit this sector. Perhaps Lakshmi would be best positioned to answer this.
So I was trying to think of examples where they use these vehicles for short-term purposes. The closest I can think of is where with the Azerbaijani, the sort of Mr. Jahangir Zahiev, who was, I think, the president of one of the largest banks in Azerbaijan. A lot of his finances were routed and hidden through these vehicles, but they were held through Trident Trust and another outfit that managed family offices. So I think in that particular case, through sort of through this money being hidden in family offices, they were able to pull money out to make sort of other asset purchases, which included multi-million-dollar homes and possibly a Gulfstream jet. So I think that's one example where there was some amount of sort of liquidity in the way the assets were held. But you're right, a lot of these assets are held in long term, and the assumption is that, oh, if you're a money launderer, you don't want to hold it long term. The one other example I can think of immediately is the sale of, not directly with these, but it's sort of with a similar complex vehicle, is with 'Ndrangheta, the Italian mafia group that was able to sell to legitimate investors, pension funds and investors all over Europe. And it was financed by the largest private banks in Europe, where they were able to sell about $1.6 billion worth in bonds. They were able to get enough money through legitimate investors from bonds that were backed for the Italian health sector. So that's another example of just a complex vehicle that allowed them sort of a quick return on money, where they didn't have to hold the asset for a very long period of time.
That's really helpful, Lakshmi. And I think too, one of the other examples that comes to mind for me is the 1MDB case, where there was money flowing. For those that might not be familiar with 1MDB, it was one of the largest corruption scandals in modern history, where more than $4 billion was drained out of Malaysia's development bank. And some of that money was routed through offshore private investment funds, I think to the tune of, maybe turning over one every week, being able to move into other investments. So again, Lakshmi, you can correct me on that, but that's an important example too, I think.
No, you're absolutely right. And I will just add that one of the things we do see as a big problem repeatedly is that a lot of the times, because I think criminal actors know that these types of funds are not subject to AML regulations, they often set up fake private investment funds. So on paper, they're like, oh, this is a private investment fund. And we saw that in the largest crypto, it's essentially a Ponzi scam, but Ruja Ignatova, who set up the OneCoin cryptocurrency scam, that's what she did. She got a lawyer in the US who set up fake private investment funds, and through which she was able to move out over $400 million. But on paper, this money was coming from wealthy European investors, and then the money was routed out and it's moved into a whole other network of assets and other investments. So that's another great example from our report as well.
Wonderful. Thank you, Lakshmi. Then let me turn it to a broader question on, we mentioned at the top of the call how this is critically important for mitigating the US's role in corruption. We're on the eve of the Summit for Democracy. I wonder if Gary or other panelists on the call might be able to elaborate why closing this loophole in the United States around the private investment sector is so important to making sure that democracy has a chance to thrive, not only at home, but internationally.
Sure, I'll start and others should chime in. I think, when we think about democracy, when we think about rather corruption in the United States, we often, when we think about this type of, global financial corruption, we think about it as happening in countries elsewhere, right? I was actually on a call earlier today, believe it or not, with folks from the Netherlands. They have an even bigger obstacle to overcome, where everybody in the country thinks that they're the cleanest, best, and least corrupt, country in the world. And so we don't really look at our role in ourselves in this process. And Transparency International does an annual corruption perceptions index, where we sort of rank countries and have scores on the perception of corruption in a country. And as you might imagine, Western democracies do better. Some of the other countries that we normally would think of do worse. But there's a second report that I think relates much closer and is much more appropriate for this, for the topics we're discussing today, which is trouble at the top. And what that means is look at the countries at the top of that corruption perceptions index that do well. And what you'll find is they are money laundering centers, that the money may come from outside the United States or from outside Western democracies or European countries, but that because of the loopholes in our financial laws, that money is able to be laundered. We are enabling the world to further democracy, to further corruption, undermining democracy. You see the rise of authoritarian governments that are using, and the report has a bunch of examples, but even beyond that, I mean, if there were examples, we just had too many and we couldn't use all of them, but you begin to, in sorting through all of that, you begin to understand how the US is facilitating corruption abroad, and that undermines democratic institutions. Everything from just stealing money that would otherwise go to provide healthcare and education and other basic services, all the way to military officials in other countries stealing money, using it to pay off private militias, or using it for otherwise suppressing opposition voices and committing massive human rights abuses. So if you're talking about a summit for democracy, you can't literally have a summit, invite 110 countries without addressing the role that advanced economies play in helping move money and facilitate the money laundering that's happening around the world. And we hope that the summit, we expect the summit will address this issue, but as well as real estate and other ways in which money is laundered through the Western financial system.
Great, thanks so much, Gary. And you raise a really important point around real estate. I know that's been a feature of some of Global Financial Integrity's research, and there seems to be a growing role of private equity in the real estate sector. So I wonder, before turning back to our other panelists, if Lakshmi, you might be able to shed a little bit of light on that and talk a little bit about GFI's research there.
No, thank you. Thank you so much, Eric. And, it's a privilege because, it's a privilege to sort of talk about it, because I know all of us here that are working on this sort of are trying to sort of, push the advocacy agenda forward on real estate. And, at the heart of it is really the fact that the current US GTO regime, which is meant to tackle real estate money laundering, primarily only focuses on residential real estate, where essentially the purchaser of the home or property, who's the beneficial owner, because it's usually just one person, is also often your money launderer. There is that very close nexus between that, the purchaser and the money launderer. Now, with private equity, we start entering the arena of commercial real estate, by which I mean, commercial real estate can include homes, but it means that you're buying an entire condo filled with apartments, or you're buying 30 or 40 homes in a residential neighborhood, or you're buying a hotel, a strip mall, all of that, all those larger scale investments typically fall under commercial real estate. And the truth is, you can have, when you're acquiring those properties, it is not one person buying it. It is usually a collective, a group. It has two investors, three investors. And very often you have private capital and venture capital and private equity funds investing in this space. And what then becomes problematic is if you own even a fractional interest can mean you are laundering $5 million. And that's what really we saw happen with Safira Capital, is that we saw essentially what we saw happen there was some drug trafficking organization was able to invest in an investment vehicle that was in turn investing in real estate, and therefore whitewash their money through that. And we see this happen all the time. And what we are looking for is our GFI's own report on the subject also looks more into this relationship of how investment vehicles should be subjected to these rules. Because if we're really looking at tackling the problems with real estate and the fact that the US, on average, we were able to see about $40 million per case was laundered on average on a real estate money laundering case, was 40 million if you divide it up. Then the way to tackle it is to address the elephant in the room, which is commercial real estate. Because as I said before, the Iranian government was able to launder $500 million to commercial real estate, and we don't have a role in commercial real estate at all in the country yet.
Yes, David, please.
Yeah, I want to echo what Lakshmi was saying, and just provide a couple examples that I totally agree commercial real estate is a huge thing, but I also think the focus should be on single family rentals. If you were following the Pandora Papers investigation, there's a great report on how Legion of Christ, which is a religious order linked to pedophilia, was able to invest hundreds of millions of dollars in a supposedly reputable private equity firm called Pensum Capital, that bought up lots of single family homes and was renting them out and then treating the renters really badly and evicting them even during the pandemic. And I know for a fact we're going to see more and more of these investigations in the next month that are linking dirty money coming in through private equity and then buying up homes that might be down the block for you and I, depending on where you live, especially if it's in the Sun Belt. So it's touching all aspects of the real estate industry, and because there's a lot of money being made in this model, and a lot of questions about affordability and economic justice that come from, allowing unfiltered or opaque money into the sector.
Couldn't agree more, David, and a really helpful example to be able to make it tangible for folks just about how private equity is distorting markets in ways that are truly opaque. So thank you for that addition. Let me turn over now to some of the questions from our audience. Thank you again for your questions. Please submit more as we continue this conversation. But we have a question from Robert asking, what are members of Congress doing to insist on full transparency for private equity? Perhaps Gary or Lakshmi, feel free to chime in.
Senator Whitehouse referenced that he's drafting legislation. There was a bill that was introduced called the Enablers Act, which goes after, which would require customer due diligence and money laundering responsibilities for a number of professions. So it would be lawyers, it would be the accountants, corporate formation agents, as well as private investment and investment advisors. So I think that's a piece of legislation that was just introduced. I think we can expect hearings, certainly in the House Financial Services in the coming months. We'll see how that legislation moves forward, but that's right now, I think that's the largest vehicle. I think, to be clear, this has been a difficult and tough road. We had these due diligence requirements in one of the original versions of the Corporate Transparency Act. In order to get the bill finally through, we had to say, okay, we'll come back and fight that fight another day. Let's get the beneficial ownership information collected. Let's get that step taken care of. And so again, it's not something that is new or different. People have been trying to do this. And I think we're finally at a point where the education and awareness of the dangers is so large that you're beginning to see actual bills in Congress, which is encouraging, and we'll see where it goes.
Great, thanks, Gary. We have another question from John to talk a little bit more about the Corporate Transparency Act. There's obviously some intersections here, which we can talk a little bit more in depth with the Corporate Transparency Act, but he asked, when can we expect the proposed regulations for that piece of legislation? And then it will require more resources at FinCEN, not only to implement the Corporate Transparency Act, but to meet the requirements for the rulemaking that we're suggesting as part of this report. So what's being done to make sure that FinCEN has the appropriate resources and staffing to carry out these rulemakings?
I'm happy to jump in, I guess. I think we are expecting, so the Corporate Transparency Act is going to be broken into 3 separate rulemakings. We are expecting the first draft rule to be issued any day now, quite frankly. I think, we have been pushing the administration to get a draft rule out before the Summit for Democracy, and that may happen. We'll see, there's no guarantees. But that would be, I think, an important first step. The statutory deadline for a rule to be done is the beginning of January. I don't think they're going to make that, but if we can get a draft rule, we can get a better understanding of what the rules are going to look like. On the financing piece, I think the administration has proposed additional money for FinCEN. It's been included in various budget proposals. The problem is much larger than FinCEN right now in terms of passing a budget with the discord in Congress. But if they pass a budget, I think we are cautiously optimistic that there will be an increase, of anywhere from, $40 to $70 million, something like that, or maybe more. And so we'll see how that all plays out. But yes, there is bipartisan support for increasing resources to FinCEN. And we'll have to see exactly how much money that is, but hopefully that is coming shortly.
Great. And just to elaborate a little bit, Gary, just for folks' knowledge, the administration requested about $190 million for FinCEN. The proposals in both the House and Senate get pretty close to that number, with the House having the higher number. So it's something that we're hoping that the House Appropriations and Senate Appropriations Committee can help negotiate and make sure that FinCEN has the appropriate resources necessary. And it's all the more important that Congress can approve a budget, hopefully before January, because there's a lot of work that FinCEN's been asked to do in the meantime. But we're very grateful for all the work and dedication of the staff there to make sure that they meet the deadlines prescribed by Congress. Great. This question is a question from Vedat. David, how can we access your report?
Sure. I think you're talking about the report on Luxembourg, which is on our website with Transparency International. I can put a link in the chat, or you could also be talking about the report for this this call, which is on the FACT website and also on a lot of emails, which I think have come in pretty recently. So yeah, I'm happy to distribute it. We just, in two cents, we looked at the Luxembourg investment industry back in February. They have universal or ultimate beneficial ownership registry. We compared it to some data from the SEC and found that just requiring beneficial ownership is not enough, that there has to be really strong verification mechanisms in place, and that unless you cross-check and unless you really invest a lot of money and resources, as hopefully FinCEN will do, these people on the other side will use every single loophole available to them to disclose either incorrect or missing information in these registries, which makes them kind of defeats the purpose and diffuses a lot of the excitement around them. But I'll happy to share the link.
That's great, David. And another question for you, actually. Recently, when we think about enforcement, no, every rule is only as good as much as it's enforced. In the question of who would be responsible for enforcing this draft rule that we're suggesting as part of the report, FinCEN will draft, but ultimately it will come to the SEC to likely implement. That was recently the topic of a federal Supreme Court consideration. Do you want to elaborate a little bit on what the decision was there?
Sure. I mean, the decision basically involved a case that reaffirmed the SEC's role in AML enforcement so that they can enforce the Bank Secrecy Act as it applies to these type of investment advisors. Now, there's a debate of who should be the right U.S. government agency to enforce a lot of this transparency the report is calling for. In some respect, I mean, FinCEN is already collecting information on suspicious activity reports and should and will assume primary responsibility for the beneficial ownership registry. So it makes sense that if the data is going to come into one point with the US government, that it maybe should be housed in FinCEN so it can be analyzed alongside these other treasure troves of information on suspicious money. That said, the SEC also has obviously a regulatory function when it comes to RIAs and is already asking them for minimal information about beneficial ownership and the structure of their investments and so forth, potentially improving that reporting requirement and allowing SEC to gather more information on the beneficial owners and also perform this monitoring function would be great. The issue is you don't want all this data stuck in one silo in the US government. It needs to be shared as broadly as possible. It's one big hiccup we're seeing with the GTO implementation in FinCEN is that there's a lot of data just sitting in the US government that's not being exploited. And there's a lot of law enforcement or activities that should be aided, but data is not being shared in an efficient and in a really rapid manner. So as we design these rules, I would think about concentrating the data in one agency where they have the resources and the capacity to analyze it, and then making it available to a lot of other government agencies to access for their own enforcement activities, rather than allowing this industry to exploit the fact that agencies are potentially competing or maybe not on the same page when it comes to information sharing.
That's great, David. And it was so many problems that come before the US government. It really does come down to information sharing, resources, and staffing. So that's critically important. Thank you very much. This question is for John from Alia. Thanks for laying out the private equity playbook. Can you please speak about how private equity has behaved during the pandemic and impacts this had on workers and communities? Elliot would love to connect with you, so we'll make sure that that happens after this event.
That sounds good. Yeah, I don't have, I guess, specific examples. Basically, it's business as usual, and private equity is always looking for the next opportunity. And when things are bad, there's more opportunities for them. They're sitting on record dry powder money, just sitting waiting to be invested. You can look at just kind of outcomes, though, for like look at private equity in the nursing homes. Like you have more deaths and workers get paid less. Talking about rental homes, like they're actually getting into like trailer parks and then just the price of rental properties. So if there's an industry, there's probably private equity coming in some way. So yeah, no real great insights there. And then on the question about the SEC, what can be done to support them is basically when they come out with rules, they need to hear from investors and users and commenters. So public comments when SEC comes out with sensible rules on this will be really important.
Great, thanks so much, John. We have time for one more question, I think. So this question is about the Pandora Papers. Pandora Papers will be the subject of a House Ways and Means Committee hearing next Wednesday. Did the Pandora Papers add to the base of information regarding the problems related to enabler industries? If someone wants to chime in on that, that would be great.
I'll take the last. I'll speak for a minute, and then if Gary, John, or David wants to go, there'll be 2 minutes left for them as well. But no, absolutely. I mean, I think as we were working through this, the expose around the Pandora Papers provided, I think, the necessary fuel to really sort of, I think, give us additional attention that we need to the investment industry, because everything that takes place through the roles of, accountants, lawyers. There is a whole industry that's set up to facilitate and support this. And even with the sort of investment industry itself, sort of setting up the structures that help with the actual investments and involves a lot of the enablers and actors that we see here today. And while, the Pandora Papers didn't focus as much on the investment sector, it focused on the sort of the real estate sector, it focused on the trust sector, it focused on sectors, I think, and, family trust that I think tie largely into what we start talking about when we sort of broaden this and talk about the role of family officers, when we talk about sort of, trusts that have long-term investments, when we talk about the role of the investment sector through real estate in sort of the examples that we've detailed in our report. And so the Pandora Papers, while not directly focusing on the investment sector, I think really pointed many fingers to, I think, issue areas that we are concerned about. And I stopped in 1 minute, so that gives anyone else time as well to chime in.
I think the only thing that I would very quickly add is, interestingly, the Panama Papers and some of the previous leaks really looked at and focused on activities outside the United States. I think the Pandora Papers were extremely helpful in highlighting, especially the South Dakota Trust, but really highlighting what we're trying to say here today is the role of the U.S. in providing a vehicle for dirty money to come through the United States, launder, and move around the world. So I just say that I think that is extremely helpful in focusing attention on what we need to do here in the United States.
Amazing.
I'll go real quick. I'll point to that one thing about the Pandora Papers that I mentioned about the religious cult. And I will say that the first wave of Pandora Papers investigations had to do a lot more with PEPs and politicians and leaders, and there will be more. And the Pandora Papers are so vast, and there were so many different intermediaries that had their documents leaked that include people working in the investment industry, in private equity, in hedge funds. And I expect to see more investigations that talk about how the industry facilitated dirty money. I think it's inevitable that we're going to be learning a lot more about how we can fill out Lakshmi's already elaborate list of cases with more Pandora Papers examples within the next 6 months.
Excellent. And thank you very much, David, for that response for all the panel. Thank you to our attendees. We're right at noon, so I'll make sure to get you out on time, but we're really grateful for your interest in this topic. It's definitely something that we'll be developing over the next few months. And as the administration considers its year of action after the Summit for Democracy, we really hope that being able to close this loophole in the private investment industry can be a feature of those discussions and that action plan. And so looking forward to collaborating with those in the call where it'd be appropriate to have partnerships, and otherwise please be in touch as we continue to work on these issues. Thanks again to our panel, to our attendees, and enjoy the rest of your afternoon.